There's always a danger in standing at a podium. People stop talking when you do that. Good afternoon and welcome to the third program in the School of Business and Technology Dialogue Series on Ethics and Social Responsibility. My name is Bob Hartle. I'm Chair of the Management Department here at CSS. Today's topic will address the nation's financial and housing crises and how those topics affect our community and our region. This dialogue series was conceived by our school's faculty to learn firsthand what leadership attributes contribute to ethical and socially responsible organizational cultures. The lessons that emerge in these sessions will help us to integrate leadership, ethics, and social responsibility throughout our curriculum. In addition, it's the intent of this program to share what we discover with other business schools that may wish to use it. And to that end, today's session is being videotaped and will be streamed on our school's CSR webpage. Before I introduce the panelists, who we're very honored to have with us today, we wish to thank the people who make this series possible. First, funding for these dialogue series has been provided by the C. Charles Jackson Foundation and by the Blandin Foundation, both of which have very strong ongoing commitments to leadership development and to higher education. We also wish to thank Minnesota Power, which has generously provided their video conference facilities for the dialogue sessions we've already delivered at sites outside of Duluth. And we wish to thank the Duluth Area Chamber of Commerce for their help in involving the Duluth business community in all of these sessions. Finally, we'd like to thank you, students, faculty members, business people, and interested citizens. I should also mention that following the dialogue today, we're planning a half-hour reception for panelists, students, and our guests. Please join us in the reception area just outside the doorways here in the Mitchell foyer if you're able to stay and talk to our speakers. Indeed, we're honored to have with us 4 experts from our region who will be able to provide insights into today's topic. And I'll introduce them in alphabetical order, starting on my right. First, my colleague, Tony Barrett, Professor of Economics here at St. Scholastica, a frequent media commentator on the economy and its local and regional implications. Keith Hamry, Community Development Manager for the City of Duluth, is next. Keith's turf includes administering the city's community development program and its various entitlements. He's a very talented planner with whom I had the pleasure of working during my days in government. Pam Kramer is the Executive Director of the Duluth Local Initiative Support Corporation, or LISC, overseeing work with public, private, and nonprofit sectors to transform distressed neighborhoods into healthy communities. In addition to her leadership here in Duluth, Pam also has a strong voice at the national level on these same issues. And last, my friend Stephen Lewis, Chairman and CEO of Western National Bank, Western Bank Cass Lake, and the Lakes Region Insurance Agency, LLC. When our school began its corporate social responsibility initiatives last year, Steve was one of the first business people to step forward and provide us with support and guidance. His organizations have engaged in corporate social responsibility long before the term had become popular. So I'd like to thank our panelists for joining us today. We'll begin the session with overviews from each of the panelists. I'll try to provide some prompts to each of you to kind of get your initial comments focused, but don't be afraid to carve out your own territory. And knowing each of you as well as I do, I know you will do that. After the panelists have shared their views, we'll open the floor to questions from the audience. Alex Tuttle is going to run a mic around. Alex, will you wave so people see where you are? He's eminently qualified to run things around. He holds most of our school records in the middle distances in track and field, so make Alex work. So let's begin. Tony, will you be so kind as to give us your Economist overview?
Okay, my assignment was to lay out sort of the big picture, the context in which real estate in Duluth is sitting in. So that's what we're going to start with. We start with one basic fact, and that is we are currently in the midst of the greatest financial meltdown since the Great Depression, which is about, 78 years, 79 years now. That's not deniable. And it's also happening alongside or coordinated with the worst recession we've had since the 1981 to 83 recession. So that's, for any industry, this is a very challenging time, and for real estate, obviously, it's worse. Okay, now before I start getting organized and theoretical on you, I want to throw two caveats out. First of all, a financial meltdown of this scale is complicated. It's also, excuse me, it's also not linear. There are a lot of feedback loops, and when you get in a situation like that, it's hard to look back and say, oh, this is where it got started. What that means, though, is there's no one cause, and there's no one person to blame. Part of our culture, I guess, is to blame someone. When something goes wrong, blame someone other than ourselves, obviously. You want to point the finger at someone. In a situation that we have now in this world and in our country, there's a lot of people and institutions to blame, so don't look for the one thing. Now, this crisis did get started with housing, and that's as far as I'm going to take it. I'm going to explain how the crisis got started in housing. What made the crisis a full-scale panic and a worldwide phenomenon were factors outside the housing market. So those just won't be the subject of my thoughts and comments right now. The second caveat is when we're going to be talking about housing and real estate, you have to remember that there is no one real estate market. It's not like the market for milk, Coca-Cola, tennis shoes, where you can ship tennis shoes from California to Wisconsin in a matter of a day or so. You can't ship real estate. It's a very local market. So you can talk, and we'll talk generally about the real estate industry and things like that, but you have to remember that the national industry is really thousands of small local industries. And the characteristics of one do not always apply to the next. Okay, when you deal with what we're dealing with what's called a mania and then a panic. Another phrase that the media is using more is a bubble. The idea of a bubble rising to the surface and then bursting. Manias and then panics, the panic always follows the mania, is more traditional in economic history. And a mania or panic always starts with what's called a displacement. There's something new that allows people to think the old rules don't apply or they don't apply as much as they used to. In the real estate bubble, it was the idea that somehow everyone tying into the internet was just going to change everything. What happened for the housing market was not a change in the housing market. It was really a change in the financial market with the derivation of derivatives. The derivatives have been around for a long time, but the scale and use of them increased exponentially in the last decade. And regarding the housing market, what happened was people discovered that they could combine a bunch of mortgages into a piece of paper. But what makes it complicated is, here's my mortgage. They would cut that mortgage up into 100 pieces, combine them with pieces from hundreds of other mortgages into another piece of paper. So if I own that derivative, it's called a derivative because the value is derived from the mortgages. If I hold this derivative, I'm holding ownership of slivers of a lot of mortgages. It's really a very nice idea from an investor's point of view. It's safe, secure, it diversifies, gets me involved in the real estate market. And the emphasis is on the word, it's safe and secure. Financiers not being satisfied with that would then take a bunch of these derivatives, divide them up, and make another layer of pieces of paper or even further down. Ultimately, you end up with a bunch of pieces of paper whose value is mortgages. But people owning the pieces of paper no longer know which mortgages they're owning shares of. And these are being sold as safe and secure, and they're rated as safe and secure. This is why the city of Duluth, what did we buy, 2 million of them? 2 million of them, and we ended up getting, I think, 300,000 out of it. It's okay. But Duluth doesn't invest its money in risky assets. We bought this because it was safe and secure. Pension funds around the countries bought these, safe and secure. It was a huge, huge market for these. So that was the new thing. But to have a mania, you need credit. You need money. It needs to somehow have, you can have as many displacements and innovations as possible, but for a real mania to take off, there's got to be a lot of money out there. And if we want to blame someone, we can blame Alan Greenspan and the Federal Reserve for flooding the U.S. financial market with liquidity 2001, 2, and 3. Their thinking was we had a recession ending in 2001. They were worried about deflation. Their thinking wasn't criticized at the time. But with 20/20 hindsight, we had too much money out there. When there's too much money out there, the people who have it are looking for some rate of return. So mortgage rates are low. There's a lot of money out there. And now we have the security issue, the derivative issue. These are so popular that the industry that does this, it's called the securitization industry, wants more mortgages. They're not in the real estate industry. They simply need the financial pieces of paper so that they can split them up, create derivatives, which they can then sell to cities like Duluth. So they start pressuring the mortgage providers to generate more mortgages. Meanwhile, mortgage rates are really low. It's a perfect situation. And remember, owning your home is the American dream. The more people we can have owning the homes, the more stable our neighborhoods, the more stable our middle class. Personal Finance 101, own where you live. Everything feeds into a real estate bubble. Housing prices are going up, and it looks like it can't stop. Once housing prices are going up like that, then you have the investors moving in who want to buy a home not because they want the home, but simply so they can flip it, sell it 6 months, a year later at a higher price, make money. From 2001 to 2003, new mortgages went from $1 trillion a year in 2000 to $4 trillion a year in 2003. And no one was complaining. Everybody's happy. We have growing home ownership. People who own homes are seeing their equity rise, so then they can take out a home equity loan and live well. The securities industry, the derivatives industry is happy because they've got the mortgages that they can divide up. And you have the phase that's called euphoria. It's a beautiful word for it. You can't lose. You start hearing real estate people saying, you can't lose buying this home. Buy a second home. Why not buy a condo down in the cities? You can't lose. It's going to go up in value. And of course, it doesn't last. That's why you have the panic. Eventually, things started to happen in the real estate market. Because of the drive to issue more mortgages, we developed the subprime mortgage industry, really. You know, where back in the day, you needed a 10% down payment on a house. Became 5, became 0. You needed to document your income. Nah, you didn't anymore. And by the way, we can give you a really low introductory rate for 3 years, and then your payments will go up. When you don't like that, we'll just give you a balloon payment, meaning you just pay interest, and then some date you'll have to pay off all the principal. But don't worry about that because your house is going up in value. You'll have more equity. It'll be no problem. You'll be able to refinance. It just can't last. At some point, we simply have too many houses. The bubble burst first in California in 2006, spread to Arizona and Florida, where you had developers building entire subdivisions without any houses sold, just on the idea that they had the borrowed money, they could get the credit, and they could build the house, and they'll be able to sell it sooner or later. Once you started seeing a rise in defaults, as these adjustable rate mortgages got adjusted to higher rates that people couldn't pay. I mean, you have to note, people's income wasn't going up. I mean, our incomes, for the most part in this country, have been flat. So all of a sudden your real estate payment goes up, your mortgage payment goes up, and you're squeezed. Once you start having prices level off, the people who are buying homes just to flip them at higher prices, they're not interested in the home, so they start to sell. Prices start to decline. The foreclosed homes, as you'll hear from Steve, they're sold at a low price because the bank doesn't want the home. What do they need a house for? And you start to see the plummeting in values. Right now in the United States, at least 30% of mortgages are what are called underwater, meaning the homeowner owes more money than the house is worth. In a situation like that, the economic incentive, the financial incentive, is to default on your mortgage. Why pay for a $180,000 mortgage if the home is only worth $150,000? So far, most people aren't doing that because we're good Americans or whatever. For some reason, we're not doing that, but that's the threat. That's what's looming over real estate markets. Prices are down, and we were talking about this earlier. Prices are down more on the low-income housing than on the high, but prices are down all around, and we're in a full-fledged mess. I mean, the whole thing about TARP and PIPs, public-private something partnerships. Don't know what the I is for. Anyway, PIPs, that's what they're being called. All these things are an attempt to get these toxic mortgage assets and the securities that back them up off of people's books. So this is supposed to focus on ethics, so let's blame people. I've already mentioned we can blame Alan Greenspan and the Fed. They're pretty good. We can certainly blame the derivative industry that created an asset and then sold them with false marketing, sold them as safe and secure. But that leads us to the next people we can blame, which is the rating agencies who are supposed to, their job is to rate the risk of assets, and they rated these as safe and secure, but you read about them now, you realize what they get a fee every time they rate something, and they get the fee from the people they're rating, and you had the two major companies in the industry fighting for market share. That's not an environment for objectivity. So we can blame them. We can blame the mortgage issuers who, under pressure to create more mortgages by the derivative industry, pushed mortgages on people that knowing that maybe they couldn't afford it, that they could afford maybe the low introductory rate but not the long one. The phrase used is predatory lenders. You know, the mortgage company gets their fee, and they don't care whether the mortgage is serviceable because they're not going to own it very long. They're going to issue the mortgage, they're going to sell it. So who cares if the person's going to be able to make the payments in a year? It's not their job. When mortgages started to default countrywide, which was one of the big mortgage issuers in the country, they no longer exist. They're now part of Bank of America. They got just criticized severely for horrible customer service, dealing with their borrowers who are in default. And their president said, come on, we never expected to still be owning these mortgages. We're not into customer service. That's not what we do. We issue mortgages and we sell them. It's too bad we can't sell these, but don't blame us for not having customer service. That's not what we're trained to do. And like I said, they don't exist anymore. What a shame. Themselves. Heard someone today, a homeowner in Lehigh, Pennsylvania, at a factory that's doing well, just blasting co-workers who took out mortgages they couldn't afford. What were they thinking? It's their fault. Okay, we can blame them. We can blame the investors who bought real estate just to flip it for driving up prices to unsustainable levels. And of course, we can blame government regulators who didn't do anything. But the point I would make as an economist, if you look at every single one of those people, they were behaving exactly as an economist says they should. They're trying to make a profit. That's all it is. Thank you.
Thanks, Tony. That was exactly the context I hoped you would set. Anyone want to go next? Let me direct traffic up here for a little while, and what I'll try to do is give each of our speakers a couple of prompts to work on. Some of them have developed comments of their own that they're going to make, and as we go through the afternoon here, we'll also try to get some exchanges going and have the various speakers contribute to each other's responses when they have things to say. Let's start with Stephen Lewis. Steve, as a banker, your organizations make loans to homeowners in the area. Can you kind of take an insider's view of the situation for us? How did the crisis develop? What were the ethical decision points, et cetera, in addition to the comments you plan to make, if you could kind of hit on those two?
Okay. The interesting thing about the financial aspect, and I agree with a lot of what was said earlier, I do agree with the fact that Alan Greenspan was a lot at fault in the monetary policy back in the early part of 2000. And I do also agree that there were other issues that occurred at the time in 2000 that the housing bubble began to move along. And one of those is the monetary policy that Alan Greenspan, as the director of the Federal Reserve Bank, implemented monetary policies of our federal government. And our federal government for a long period of time has focused on housing, building housing especially for low-income people. This has always been a problem in our country in how to provide appropriate housing to low-income individuals. When I was growing up, there were housing projects. And those were government-funded projects that were maybe high-rises or multi-units that were built in a sequestered area in town, and the low-income individuals, people that had gone through foreclosure or had credit blemishes and couldn't afford either regular rental or housing acquisition, moved to projects, and they were in the 60s determined to be an utter failure. They failed in Duluth. They failed in Chicago, they failed in New York, they failed in Atlanta, they failed in San Francisco. So in the 1990s, the administrations at that time determined that there should be a public-private, maybe public-private nonprofit partnership to supply financial goals to move away from the projects into private home ownership. Subprime mortgage lending occurred at that time. Unfortunately, it's been taken to areas like predatory lending, which I can address in a second. But the object of going down the ladder to provide private home ownership was a stated objective of the administrations in the 90s and the 2000s. So Alan Greenspan, in fact, was implementing some of those with low mortgage rates. Unfortunately, he didn't realize that there was an inflationary bubble going, because the CPI didn't include house inflation, and so he went the wrong direction. He lowered rates rather than raising rates, knowing that not knowing that inflation in the housing market was occurring. The issue of subprime lending is an issue that has a balance both ways. We talked about the American dream. Well, they're kind of two American dreams. One is to own a home, and the other is to amass wealth. Maybe not lots, different levels. People want to become, use the word set. They want to have a home, and they want to have the resources, and they want to have wealth, enough wealth to live on and perhaps retire at some point in the future. And so they're really two American dreams. One is your house, and one is your 401k or IRA. And those were often stated as primary dreams for Americans to head for. The disadvantaged, the disenfranchised in that group were always the low income or minorities or elderly. So the market created a subprime factor, which simply said those of us that have credit blemishes or issues that can't be reached in other ways in a prime market can be handled in a subprime market. The public policy was for this, and the investors, that little derivative thing that we were talking about earlier, were looking for a little higher bump on their rates on their investment products. The mortgage rates were 4%, 5%, and 6%, and the investors thought, well, maybe I should get 8%, 9%, or 10%. We kind of hear that from a lot of shows. If you listened to them 6 months ago, they'd said, if you get in the stock market, you should get 8%, 9%, or 10%. And so they were looking for the same thing. That really came from what they call portfolio management, where a portfolio is not made up of subprime borrowers. Well, it's not made up of prime borrowers, middle class, and subprime borrowers. It's made up of some combination of the three. And so the losses in any one, the risks in any one of the categories don't cause a depletion of the whole security. And the subprime borrowing really was a welcome benefit to those individuals that were not franchised into the mortgage and home ownership market. When I started in the banking business, which was in 1970, for those that were subprime borrowers, there were institutions that took care of financing for subprime borrowers. Those would be finance companies, hard money lenders. Every realtor had their own investment portfolio. So like Edina or one of those real estate companies would have their own portfolio. They would carry their own mortgages, and every insurance agency had that. So those were the methods back in the 70s, and those are the traditional methods to borrow money if you didn't qualify for regular bank financing. Well, thank goodness we've moved beyond that, because that was very limited. It was very directed at a specific market. And we moved into a whole area called subprime lending, which then translated into portfolio management. The ethical issues, and so my feeling about subprime lending is it welcomed many homeowners into the market that couldn't otherwise have an opportunity. A subset of any market speculation or bubble, especially one with a rate of inflation between 1999 and 2003, housing inflation of 151%. Any speculation or market bubble of that size, unethical elements will move into that market to take advantage of the market. And they typically were called predatory lenders or predatory borrowers, and they dovetailed into exactly what the borrower wanted. The borrower on that low income scale wanted more money so they could buy a car or pay off their credit cards or buy a house, whatever it happened to be. And they were going to extract that from their home equity. They would extract that from their home equity. They wanted low payments. That was what they wanted. They didn't care about the rate, and they didn't care about the upfront fees. That's what they wanted, was payments, low payments. So that unwanted or unethical element utilized what the customer wanted, raised the fees, raised the appraisals on the property, and in fact took the borrowers into a place where either with ARM mortgages or up to the place on their equity, extracted all the equity out of their house so that there was no fallback position. These ended up in foreclosure. People lose their homes on one of 3 or 4 categories. One is job loss, another is divorce, another is medical issues, and the fourth is when they have no longer have equity that they can resell the house themselves. So one or multiple of those things happen, and borrowers then default on their mortgages. Those mortgages then flip back into that derivative process. I'll just mention that that in itself did not cause the break in the housing bubble. That exacerbated or accelerated the decline of the housing values. What caused our current economic crunch was the fact that those defaulting mortgages and the lowering home prices devalued the securities, those derivative securities that were being held by pension funds, college foundations, banks, hedge funds, private investors. And private investors are another story, but the rest of them, that dilution in value brought down their capital. Once you have no capital in a business, you've diluted your capital or you've brought your capital down, you can't participate in the business world. You have to have an equity position. So once those securities began to lose value, either from liquidity or from down rating or from defaults, that went right down to the capital of the company. Companies went out of business. It either turned out to be bailouts or the companies went out of business. It's kind of what we see. I will just say that one of the primary issues, I'm done. One of the primary issues is that there was in the 2000s a big change in the compensation and how we compensated our employees that were generating mortgages. And this is a big issue. We hear a lot about retention bonuses at AIG, and where retention bonuses probably aren't the problem, but companies need to retain employees. If they don't, at AIG, I can tell you right now, there's companies calling up those employees that gave back their bonuses that are promising to if they come and work for them and bring their clients, that they will get a new bonus and they'll go work for a company that's solvent. But what did happen is, and this is an ethical issue that you're going to have to look at, is many people in the mortgage industry began working on the commission basis. They have no skin in the game. They have no relationship except what's the commission that I get off of the transaction that I just did. There's no allegiance to the borrower. There's no allegiance to the company. And really the issue of commission compensation, in my mind, is, and the way we move towards this really caused a lot of the problems that we have today. That's my take.
Thanks, Steve. You actually anticipated the question I was going to interrupt to ask you, so you have ESP. Pam, LISC is well known for its very innovative approach to building healthy communities, and the impact of LISC in this region, in this locale, is certainly readily apparent. As Steve suggested, you kind of operate at the intersection of the public and private and nonprofit sectors and kind of focus on building collaboration among all those parts. Given that perspective, how do you look at the housing crisis and the situation that we're in right now? What are the ethical decision points for people that you have to work with in your line of work?
Well, thanks for inviting me to be a part of this panel. I was saying at the beginning that LISC is really an intermediary, so we're not dealing directly with the customers, and we're also not making the loans directly, but what we are doing is working with neighborhood-based organizations and with neighborhood residents to try to improve their neighborhoods and make their neighborhoods healthier places to live. We're also ultimately trying to help the community prosper and help people prosper. And I think I tend to look at it a little bit in terms of we're all guilty to some extent. I think there's an element of greed that occurred, just in terms of, Tony refers to it as that's part of the market system, that we're all trying to make money. But to some extent it got too far and detached from the ultimate purpose of trying to stabilize neighborhoods, trying to get people into home ownership, trying to perform a service, and started the connection between selling a home, or the connection between, in some cases, providing financing, was detached from the purpose of helping to get people into a home. I also think to some extent we started pushing a little bit hard on the home ownership rate in our country. I don't think at all that was the cause of this crisis, but I think at times we need to look at that there's nothing wrong with rental. and that there are other housing options. So if you look at the statistics of first-time home buyers and people who did participate in homeownership counseling classes, who did participate in working with more traditional lending approaches, including state housing finance programs that benefited low-income people, for the most part, those were not the people who ended up in trouble. What the people who ended up in trouble were those who borrowed again against their properties, went deeper, as Stephen said, lost any equity, and borrowed more than they could afford. They were people who perhaps went to a predatory lender. We were talking about in St. Louis County, there's a part of up in Hibbing where it appears that there was a lender that there's more losses in Hibbing and kind of a concentration of foreclosure there. So I think there's a lot of greed all around, and to some extent it's greed and blame all around. But I also look at who's not to blame, and I would say who's not to blame is housing counseling institutions who have done a good job, organizations like Northern Communities Land Trust, a land trust organization that really works closely with the lenders and works closely with homeowners to make sure that they're aware of what they're getting into. And I think overall, the goal of homeownership is still a solid one. We just need to get back to not detaching the financing and the people from what we're working on as we're looking at home ownership and as we're looking at financing. I had a couple of statistics just to put a face on this. In Duluth, we have Duluth and St. Louis County numbers, and we are fortunate that we haven't been impacted quite as much as in the Twin Cities area. They have a very, very high rate of foreclosure and a lot of concentration, but our numbers have gone up, and anyone who loses their home is really impacted, and the neighborhoods are impacted. In 2005, we had 81 foreclosures in Duluth. In 2008, there were 239 in the city. With the county, 219 foreclosures and 476 in the county. If you look at Minnesota figures, it went from 6,466 in 2005 to 26,265. So it's, the 6,000 up to the 26,000. Huge increase. And those are kind of my preliminary thoughts.
Okay. Thanks, Pam. Keith, why don't we bring into the discussion, as the community development manager for the city and also as a public administrator, how is the housing crisis impacting our community and neighborhoods, and what types of ethical issues arise for the people in your line?
Certainly. Thank you for inviting me, and I guess to start with, I'm from big government and I'm here to help. My office is funded by the Department of Housing and Urban Development, so we receive federal funding, which Stephen mentioned looks at affordable housing and the public policy that the federal government, which translates down to state and local government, how do we promote affordable housing? And primarily the trend has been for the last 20 years, affordable home ownership within our communities. Just to follow up where Pam was at with a few statistics, housing is localized, and what we look at is we look at the local housing market and look at trends and analysis of those trends to say where should we be investing those federal resources. In Duluth, we've got a very old housing stock, which they look at the average age of a house as being 40 to 50 years old. So more than 70% of our housing stock is over 60 years old. Our rental vacancy rate, we're just completing this 2008 study, and our rental vacancy rate is about 5%, which an economist would say that's a healthy rental vacancy rate. The landlords will tell you that is bad because they're losing revenue, and so they don't want to have vacancies. But a healthy rental vacancy rate means rents stay lower. When rents stay lower, people don't get into a point where the cost of housing is more than their income, and they're able to, as Pam mentioned, possibly be renters for a much longer time. With the housing market as it has gone over the last couple of years, we've seen about a 20% reduction in housing sales, which is kind of a reflection of that burst in the bubble. Duluth had a very low housing value. When we go to assess houses and put the assessed value, which is what we then translate into taxes, property taxes that people pay, which funds government and improves the streets and looks at our infrastructure. For the first time this year, Duluth is at what they call 100% of the market, meaning what we're assessing the property values at is 100% reflection of the current market. And based upon the assessment laws by the state, if we're at 100%, we can't be there at the assessed value. We have to actually drop values. So for the first time in probably about 20, 25 years, the city is actually dropping assessed values, which means we're going to collect less revenue as far as property taxes, and that's going to have a dramatic impact not only on local taxes, but also part of that property taxes goes for state taxes, and so that's going to have an impact on the state budget. When you're too low on those assessed values, the state will come in and say you have to raise them by 5 or 10%. So while Duluth is looking at that, there's a couple of cities on the range, Virginia and Eveleth and Hibbing, they're being told they're going to have to raise values by 10%. So that, almost like a double whammy. You maybe are looking at your job being in jeopardy, and now you're going to pay more property taxes. So your housing situation is probably becoming a little bit more in jeopardy. We saw in these housing values and trends, we also saw that the cost of replacing affordable housing units or home ownership units over the past couple of years have gone up by 15 to 20%. We had talked about that being a subject of supply and demand. Hurricane Katrina and Rita had been using up a lot of the construction supplies, so we were seeing rates go up. And so what we started to do as we looked at these trends, we started to say, we have an older housing stock. We probably need to be looking at how do we reinvest in our housing and how do we make sure that we're staying kind of balanced. From a government side, we're looking at, as I mentioned, that strategic, how do we invest the funds? How do we make sure that we're providing what's called the public purpose, affordable housing opportunities, both rental and home ownership, for people at 80% of the median income within the city of Duluth, and that for a family of four is about $58,000 a year. And to translate that into how many people in Duluth, according to the 2000 census, that was about 37% of the population. So that, just to give you an idea of how that translates there. We also saw probably one of the other, I'll go to maybe some of the ethical issues. What we saw within our public housing development or affordable housing developments, the return on investment, Steve mentioned that most developers look for a return of probably about 8%, 9%. Within affordable housing, we kind of made that an artificial level. We said that return on investment should be somewhere between 12 and 15%. So that was not a reflection of the true market, what was happening. Another thing that we started to do from public financing and lending was to say that we want more people into home ownership. They maybe don't have the best credit scores, so we should allow them to have lower credit scores to get into some of these Class B mortgage products, they would call them. And one of the other things we would advocate for from an affordable housing side is we'd say we want to see higher debt-to-income ratios than what more normal lending underwriting criteria would allow. So that people, they maybe have more credit card debt, they maybe have more student loans or other debts they need to pay, but that ratio of their debt to that income should be, we should allow it to be a little bit higher because that way they can buy that house rather than staying a renter. So if there are some things that government could be blamed on, it would be being an advocate for those affordable housing pieces and saying, yep, we should let lower credit scores, that debt-to-income ratio, we want to make sure that is raised a little bit, and then probably that artificial return on investment.
Thanks, Keith. Well, I have one question for you. In terms of the stuff you've been talking about the last couple of minutes, kind of the public policy issues, What are the ethical issues that you see on the horizon that municipal governments and public entities are going to need to face that they haven't already addressed that are related to this whole crisis?
Well, the ethical issues from the governmental side are going to be how do we, knowing that values and property taxes are going to be one of the major focuses people have with housing and not wanting to pay taxes. We don't want to pay taxes. So how do we invest in those roads? We all drive around Duluth, and we could probably name our top 5 potholes that we'd like to see filled by tomorrow. And so we probably have a balancing act to have to do. And probably the other, and that's with infrastructure, the other balance we need to look at is if we're not going to collect as much revenue and the state budget's going to have the crunch that it has, we have to look at how do we reduce services. And is the public purpose of affordable housing still one of those key components that we need to be maintaining?
Good. Thanks. Tony, do you have reactions to comments?
Well, I just want to follow up on that. I mean, we've talked about this in some of my classes, is that what we're going to have to deal with as a nation is this issue of debt. We have fueled 10 years of great economic growth. We've helped the whole world with their economic growth, and we've done it with personal, corporate, and public debt. And those days, that's what's led in part to the crisis of the last year. But the whole relationship of having to pay for what you want. You want to buy a house when you're young? You have to have some equity. You have to have a down payment. And if that means you have to wait, I think that's what's going to happen. But that also translates to the city of Duluth. As not a taxpayer in the city of Duluth, I live outside city limits. The roads bother me. It tells me that this city's not taking care of itself. So this Saturday, I've been invited to address the city council about economic development, and that's something I'm going to point out. If you can't take care of your roads, how are you going to attract a new business? The message you're sending is we're cutting corners. And that's an issue we have to deal with. If we don't want to pay more taxes, what is it we want to give up? Do we want to give up parks and recreation? Do we want to give up another snowplow? We have to start making these choices, both locally, statewide, and federal-wide. And the government has a major income distribution role. We tax certain people, and certain people benefit. And that's really going to be a national debate, I think, for the next 10 years.
Let's open questions to the audience if you have them. Wave your hands wildly so that Alex can see you. He'll run a mic to you if you have a question.
Can I ask a question?
Yeah.
I want to go to Steve because this is something we were talking about earlier and I learned. Can you just talk about foreclosing? I mean, I know I asked him if they keep the mortgages they issue, and he says some they sell, some they keep. And then I think Pam asked him, have you foreclosed? And yeah. What do you do with a foreclosed property?
Well, that's an interesting point. Banks don't want. When we enter into a relationship with you, we enter into a contractual relationship that allows us our principal plus some interest back. In order for you to make us feel better about it, you pledge your house. So what we want is we want the amount we lend you that we in turn have borrowed from our depositors and other public sources, as well as the equity that the owners have put in. What we want is interest in principal. That's all our contract says. So we have lots of rights to do things if you don't agree to the contract. So if you come into the bank, we have you sign all these documents, and really the only two documents that we care about, most of them are regulatory documents, the only two documents we care about are the note and the mortgage, and those set out all the contract terms. Interestingly, I've never had in my life as a banker, I have never had a mortgage customer bring in an attorney to review their contract, which would be a typical, if you were a business person, you would have your contracts reviewed before you sign them by an attorney. Never, but Most people say, where do I sign? Don't want to read it. I'll trust you. Well, that can be big trouble in the contract world. But that being said, we didn't want your house in the first place, and we didn't want it after you after you decided not to pay for it. And but we do have rights because we have to pay our depositors back. So we get the house in. Infrequently there's not enough in today's market. There was always equity in the past market to bail everybody out, so nobody worried that much in the lending business. But now with equity decreasing or values decreasing, equity is gone and the properties come back. We do a quick cleanup, put them on the market with a realtor and sell them hopefully for our balance. If we don't have our balance, then the depositors don't make it up. The owners do out of our equity. So someone has taken a loss, effective loss on that transaction. The process drives down home prices in a particular area. So besides it being bad for the owners or investors in the business, it's also bad for the rest of the neighborhood and the rest of the the rest of the property owners in that neighborhood. Plus, it drives appraisals down. So if you're a good borrower, always paid on time, you want to live in your house, you paid $180,000, you want to refi for a new rate, and you go out and get a new appraisal and find that the foreclosures in your neighborhood, someone else's problem, has driven your house value down to 150. You're out of luck. You can't refi. Your rates are going to be the same as what you had until you bring that price down to 150,000. So mortgage foreclosures are complicated. They affect a number of people, and they're extremely undesirable from the community standpoint.
Good. Other thoughts, questions?
I'd like to jump in a little bit on that, because right now we're looking at the Neighborhood Stabilization Program funding that we're going to receive from the federal government, which is to address foreclosures. And we're really looking at from as the program says, neighborhood stabilization. We don't want to see the broken windows. We don't want to see the overgrown grass and the units sit there vacant, because that's a deteriorating influence upon the neighborhood. But Steve is very correct in the fact that it drives the values down, and one of the requirements of that program is that we have to get a 15% discount on the appraised value of those units. So that federal policy decision, because the taxpayers across the country have said we don't want to see large bailouts here. We don't want to see people who made these poor decisions, who got into a house that they shouldn't have bought. We don't want to see them taken care of. So the first thing is we can't help anybody who's in foreclosure with that program. And the second thing is that we have to get a discount, which again, that affects the rest of that neighborhood from a standpoint of it reduces the value, it reduces somebody else refinancing. But the ultimate goal is to get it occupied again. So trying to get it purchased and rehabbed and put back into home ownership is a good goal, but it's got some counter influences on this end. So from a federal government side, we're trying to grapple with that.
I'll piggyback onto that from our standpoint, from a LISC standpoint, where we're trying to make sure we don't have neighborhoods with vacant properties. And the ethical issue for us is that we're trying to encourage our nonprofit partners who we help fund to get involved in the neighborhood stabilization program. They're looking at it and saying that's taking a lot of risk in some situations. And in some neighborhoods, they're not sure if the homes will sell. So we're in that situation of trying to fund these organizations to improve the neighborhoods, to take the risk. And basically what we're ending up doing is trying to partner people together to make sure that we take care of the condition of the non-foreclosed houses, to try to find a way to help fund the nonprofits. But in some cases, we have to back off and say ethically or from a business standpoint, this may not be a smart move for this nonprofit to purchase this property. So we're just starting to get into that in partnership with the city, trying to figure out how we tackle some of these issues.
Great. Maybe if I could follow up too, Bob, I'd like to ask Stephen, what One of the tools that they want us to look at is contract for deeds, which is something that's not been around or widely utilized for about the past 10 years. How do you think the lending institutions are going to look at contract for deeds?
Contract for deed was a fairly easy approach years ago, and the reason is that the most attractive part about a contract for deed is the cancellation process is much quicker. And so in a normal foreclosure process, between the time the borrower stops making their first payment and the financial institution gets control of the property, maybe 18 months. So if you're during which the borrower does not have to pay any of their payments or taxes or other assessments against the property, or will probably not do any maintenance. But a contract for deed allows a lower equity position, which may be the case here, a quicker cancellation. So if the borrower defaults, then they're done. I know the county has sold land on contract for deeds in the past, and it really allows for a recapture of the public equity quicker.
Questions from the audience? Wave your hands wildly if you have one so that Alex can see it.
I just want to say in my business, all my employees are paid to have an opinion. So we ask that that's part of the process. They have to have an opinion. So I'd like some questions if it's possible.
I got actually two questions for you. My first question is, you probably followed the pictures from the recent G20 summit in London, and also with all the bailout money that banks are receiving. There's some public uproar going on about the image of the industry. So my question is just, how concerned are you about the image of the industry and about your personal standing in the community?
Is that for me?
Yeah.
Okay.
And my second question was, how many of those mortgages do you actually keep? Do you all sell them to Fannie and Freddie Mac, or do you actually keep them on your books? Or?
Well, those are a couple of really good questions. I can't comment on G20 because that's outside of my area of expertise. I can comment on the bailout money that's been given to banks and its image. When the TARP funding came out, we looked at the housing trends and the potential. Each thing that happens has I like to think of it as a pebble in a pool. There's concentric circles that flow out, that each thing affects something else. We thought that the housing market might affect employers, which might affect employment. And so we were concerned that each one of these ripples would have a wider effect onto the economy. It doesn't look like that's happening to the degree that people thought that it might occur back in November of last year. But at that time, the former Treasury Commissioner, the head of the U.S. Treasury, put out the TARP program, and we looked at that, looking at the concentric circles of ripples of economic impact, and so we, as well as probably every bank in the country, looked at the possibility of bolstering our capital with TARP money in order to continue to keep lending, assuming that the economy went down further, faster, and these circles all became worse. Well, fortunately, from our standpoint, we looked at the Duluth area, and we're a community bank, so we deal only primarily with the Duluth area. And we said, not interested, don't need it, we have enough capital of our own, and we think we can weather the storm. However, banks in the Twin Cities, where the economic impact has been much broader, did get involved with the TARP program, and I think rightly so. I think clearly under the current Treasury administration with Mr. Geithner, I think that there have been more political strings that have gone into the TARP program than under Paulson. That may be good or bad, depending on how it goes. As far as Fannie Mae and Freddie Mac, Well, we made a decision. We thought Fannie's and Freddie's position back in 2003, 2004 was becoming too politically driven, and we stopped doing business with Fannie and Freddie. Matter of fact, we didn't buy any securities from Fannie and Freddie. Most of the participants that were involved with Fannie and Freddie sold a lot of loans. They had to buy stock in order to do that. Most of those banks or financial institutions have had to write off their value of stock ownership in Fannie and Freddie.
Other questions?
This question is directed towards everyone. As a college graduate, we're going to be leaving with a significant amount of debt, and our credit scores aren't going to be as high as they normally would. What programs are there for us that would help us to secure a home, to secure loans, to help us stay in Duluth? Because if the jobs start drying up here, the more people are going to leave, the less amount of money that's going to go back into the city. Roads are going to start to deteriorate more. So what programs, I guess, are offered to help us to be able to stay here?
You want to take it, Pen?
The director of the Community Action Duluth program is saying that we should start a campaign that now is a great time to become a homeowner. And I think there are a lot of resources, and we'd love it if you did stay. So one, I would really encourage people to take advantage of the home ownership counseling and training programs Neighborhood Housing Services offers that just kind of gives you a real broad background. Community Action Duluth, depending on your income, would have a FAME account. It's a match savings account. It's family assets for independence in Minnesota. And it's an income-eligible program that works with people to match their savings, and they can save towards education or starting a business or buying a home. There's a new tax credit program that I'll probably ask somebody else to talk about the details, but that's a federal tax credit program for home ownership that's available. And then also, again, an income-dependent program is Northern Communities Land Trust. NCLT has a program where you're purchasing the home, but the land is owned by the land trusts. So you're basically getting equity. It's a limited equity in the house, and it's a long-term lease. When you sell your house, the house remains affordable to the next low-income buyer. But it's a great program that they've helped about 150 people into home ownership in the community, so that's a good resource. There are state first-time home buyer programs. There's some great programs through the local lending institutions. But again, I'd start with an NHS home buyer training, talk with Community Action, and I think there's the fact that prices are down and realtors are looking. If you have good credit scores, realtors and banks are looking to work with you.
Thanks, ma'am. Anyone else?
Yeah, the Federal Reserve Bank did a survey along the lines of answering that question, not directly but indirectly, and they indicated that the number one reason that people choose a city to live in is to take advantage of economic opportunity. That's the number one reason. The other ones might be like, it's close to a lake and I like to fish, or housing prices are low. But the number one is, can I find a job? Do I have an economic opportunity, and can I advance my career? You have to decide whether that fits your criteria for Duluth or not. One thing to keep in mind is that housing boom and busts are cyclical. They're usually a 10-year swing, is that right? So if it started in 2006, we should be hitting a low in a couple more years and then up again. So keep in mind that the housing market is always going to cycle up and down, and that this market the Duluth market and other markets will run along the same lines.
Good. Thanks. Anyone else in the audience? I'll come back to you in a couple of minutes. I've got some questions of my own. Tony, based on what you've heard from the panelists so far, can you kind of step back and look at the situation again? I know he is a good prognosticator. I listen to your forecast of what's going to happen to the economy on public TV every year. Where do you see this going? What do you think the lessons are that are emerging, and how do those things need to be addressed? You kind of signaled the areas that were at fault to some degree.
Locally or nationally?
Maybe both.
I think one of the advantages of living in Duluth is that we don't have the booms, therefore we don't have the busts. We never grow spectacularly, we grow nice and steadily. So that's a good, for someone who lives here. I think this country is on a threshold. I think the world that you all are going to grow up and have your professional lives in is going to be fundamentally different than the one I did. I believe that the age of the United States is the engine of growth for the world, and the greatest place for the rest of the world to put their money is over. And that means our debt is not going to be as easy to get a hold of. Your student loans will have higher interest rates. Your mortgages will have higher interest rates. Your car loans will have higher interest rates. And all those things will reduce your lifetime consumption. And with that, you consume less, our economy grows less. So sounding like an economist, which means I have to be pessimistic, I think a very good case can be made. And maybe I'm being biased because I'm teaching a class right now on manias and panics and the Great Depression, and I'm really focused on a lot of the similarities. There's a lot of very depressing similarities between now and the Great Depression. And I really do believe economists are always predicting disasters. And I've always resisted that. I believe we always muddle through. We don't have a resource thing. That was the big thing when I graduated from college. Oh, limits to growth. We're going to run out of resources. Well, folks, I graduated from college 34 years ago, 35 years ago. So take my prediction of doom and gloom here with a bit of grain of salt. But I believe the age of us as the economic power of the world and the gluttonous over-consumers is coming to an end, and that's your generation. And you're gonna pay for the $1.8 trillion budget deficit we have this year, and higher taxes, which will reduce your consumption, which will reduce economic growth. And I believe we are really in a negative cycle right now, working for the city, working for the government, where you have all these public demands for affordable housing, for parks and recs, for roads, for schools, and people's incomes are being constrained. That's an untenable situation. So that's what I'm walking away from this current economic crisis with. I believe it. Every time we have a major economic crisis, it's because something was fundamentally wrong. The 81-82 recession, the fundamental problem was we had too much obsolete industrial capacity in this country. Well, a 2-year recession with 10%, 12% unemployment takes care of that. That's where the phrase Rust Belt came from. It's where Duluth lost 15,000 people. This fundamental crisis, the fundamental problem with this crisis is debt. It's mortgage debt, it's U.S. government debt, it's just debt. And look at all the stories of businesses whose whole business model was built on easily accessible short-term debt. It's not available now, and they're going bankrupt. Families, young couples who took out a home mortgage, who borrowed money for their wedding and all those other things, their student loans. All that debt is burdening them, keeping them from consuming. And I really do, my personal belief is I think this is true, but I think a really good case can be made that we have passed a threshold in this country, and we've got to start living within our means. It means higher taxes, less consumption, higher interest rates, whatever, however the adjustment will take place. But I really do believe your generation is not going to have as good a time as mine did. Sorry.
You gave me the provocative response I was hoping for. How does the rest of the panel feel? Are you a pessimist too, or where do you think we're headed?
Go for it, Keith.
Well, I'll jump in a little bit. I think what Tony mentioned as far as government goes, that it is an untenable situation, and we are going to be faced with reducing government. We are going to be faced with reducing services. We're going to have to look at others, whether it's user fees, whether it's for recreational services that we want to have in our community. Schools. Schools, I think, are at a fundamental issue right now, especially in the state of Minnesota. That whole educational model is just being tipped upside down and needs to have a different business model on how we fund it, how it works within our communities. So we've got some real challenges from a governmental side of reduction of services, and then taxpayers are going to look and say, I'm paying taxes, and what am I getting? So that's one of our big crucial issues.
How about you, Pam? The role that your organization plays and you play is somewhat that of an advocate in working with some of the public agencies who are going to be making those adjustments. How does it change your stance in advocacy or what decisions you make in your organization?
I'm trying to not always be the glass is half full, but I just think that way. And I think what I see, it's huge challenges. I was thinking about my answer to the earlier question. I think we have to be really careful about taking on debt and taking on, responsibilities and wait until we're ready. I guess I see some opportunities for people working together to look at a simpler way of living to some extent. It's taken the buses, it's green building, it's energy conservation, it's looking at living within urban neighborhoods, creating walkable neighborhoods. So if Tony's prognosis and Keith's comments about how do we adjust to major changes, I think there are some ways that we can do that can create healthy lifestyles and create kind of their community building ways. And some of that we're already starting to look at smaller houses, looking at units where one of the units is rented and one's for sale. We're looking at some of the stimulus funding about really investing in green jobs and creating opportunities for training programs for weatherization and for kind of reducing our costs. So from our standpoint, it's taking a look at adjusting from a time of wealth and expansion and increase consumer spending to how do we work together to adjust to this and maybe build a stronger community and invest in what matters more.
Steve, you have 2 cents worth?
2 cents. 2 cents is this country's economic power came from between 1940 and currently from mostly from the fact that we're very creative people, but we also took the advantage of a very low cost of energy to drive our country. Electricity, heating, power, petroleum, whatever it happens to be. There are sources of energy that perhaps can continue that progress, and that will probably determine ultimately low cost of energy will probably determine the impact and the breadth of our economic recovery. I will say that I see several economic models happening in the area. I'm not quite as downbeat as I don't want to say that. But I'm not quite as downbeat as what I think we may. I think we see an economic model where customers and businesses are downsizing in their houses or in their power consumption or in their employee numbers, and that's a decision made by owners and shareholders and marketplaces. That same marketplace is driving other owners to raise their prices. It's an interesting model. Volume goes down, so in order not to lay off people and customers, you keep the same level of service level, and you raise your price. So you have less people, but you cost more. That could work. And the last one is another business model is people have become just simply more competitive. They've understood that there's a lesser market, so they need to draw it into their enterprise in order to maintain their personnel level and their profits. Some businesses, as an adjunct to that, are adding people. So my sense is it's not clear at this point because there's so many where the economy is going right now is so unclear, and we have so little specifics, and there's so many variables, and there's many countervening forces. You try one thing and something else bad happens that you didn't anticipate. And so I think what we're dealing with is not necessarily a glass half full or a glass half empty. It's just one that we can't decide whether it's full or empty, and we really have no idea at this point. And so there's many different models. Some will be successful, and some won't be successful. The risk of unsuccess is much greater right now. But I guess I see it as in a much more optimistic view, in that I think it's only the fact that we can't see forward, which we could a year ago or 2 years ago, it's causing the economic downslide. And once it becomes clear and the plan becomes specific and the variables are taken out, my sense is that those that are good operators, good employees, and good companies will continue to generate opportunities.
Thanks. Let's give the audience one last chance for questions, if there are any.
Sorry, I have one more question. Tony, this one's for you. You talked about debt, and a lot of us are going to be leaving school with a lot of debt, but with the job market drying up, it also opens up to stay in school more. You want to try and ride out the recession in school, but in that process, you're also accumulating a lot of debt. Is it the most feasible solution to go to school or to pursue higher education when you are going to be amassing $30,000, $40,000, $50,000 coming out of college, having great credentials, but therefore it's harder for an employer to hire you because you do have all these credentials?
There's no black and white answer. There is a structure to analyze the issue, though. The point of borrowing money to go to college is the same as a firm borrowing money to buy a new piece of machinery. It makes sense to do it if the cost of that financing is going to be more than offset by the increased income you're going to generate as a college graduate or someone with an MBA or MD or whatever graduate degree you want to add. So that depends on what field you're going into or what you think your job prospects are. Obviously, at a private institution where most of our students are taking out student loans to attend here, it's in my self-interest to tell you it's an excellent investment. You know, you should be borrowing. It's not the same as borrowing money so you can buy a sweater this week that you're going to pay off with interest in the future weeks. That's a waste of your money. That's reducing your consumption over your lifespan. But if you're investing to make yourself worth more in the marketplace, it will pay off. The question is, will you be worth more in the marketplace? And the answer to that is unclear because I can't see the future. But certainly historically, borrowing money to attend a college pays for itself.
Anyone else? I'll throw out one last question for each of the panelists to respond to, and then when we're done, we'll call it quits for today. You kind of shied away from prognosticating a little bit, and I understand the difficulty in seeing the future, but I'm going to try to force you to do it because we do have videotape, and it'll be fun to look back 5 years from now and prove who was right and who was wrong. Where are we going to be if we fast forward 5 or 10 years on the issues that we've been talking about today? That's the first question. And what do you think the ethical lessons or leadership lessons are that have emerged from the current crises. That is really to connect it to the theme of the grant-funded program that we're doing today. So where are we going to be 5 or 10 years out? What are the ethical issues and the leadership issues that have emerged from our experience? Steve, will you start? And we'll just work down the line.
That's a tough question, and I didn't have much of a chance to prepare for that. I do think my quick sense on that is the key to it is not going to be in short-term stimulus or funding. The stimulus package that we have really translates in primary focus towards maintaining an employment level. We're all worried in the economic circles and about unemployment becoming too high. So the current stimulus package really only focuses, in my mind, on maintaining the employment levels at an acceptable level. Let's say 10% might be a good number, or 12 or something in that area. And so the real critical process in determining where we'll be in 5 years is going to be the cost of energy. And since someone asked about the G20, it is what other countries globally are going to do to during these downturns. Will they do the same thing we're doing with the stimulus package? Well, I guess we heard no from the Czechoslovakian minister, the head of the EU, and we know that China probably isn't. They're modernizing their steel industry to effect a greater competitive advantage when the recession bumps out. So I'm not absolutely certain. My current sense is that the stimulus package gives us a floor, but it doesn't give us an edge in 5 years, and a lot depends on the ultimate cost and availability of energy to power the economy as it comes back.
Good. Thanks, Steve. Pam, where are we going to be 5 or 10 years out, and what are the leadership and ethical issues that have emerged from today?
Well, I think we are going to, I'm going to do the local view of where we're going to be. I think we're going to start concentrating more on energy issues. I think we're going to start concentrating more on more social enterprise, more entrepreneurship, more small business development. We're going to be looking at smaller homes and recycling more and investing in our infrastructure. I think from some of our government programs, we're going to see a downsizing. We're going to see people having to pick up some of the responsibilities. And, you know, in our own nonprofit community, we're already seeing that with nonprofit youth organizations saying, how do we help with some of the summer recreation programs? How do we help out with the school situation? So I think it could be, we'd be heading a different direction, simplifying. So some of the ethical issues are the whole consumer, you know, learning that we've had about in order to prosper and to drive an economy and keep things going that we have to spend money. And ethically, that's going to be an interesting thing to watch. You know, how do we continue to prosper? What are ways that you can make decisions about are you staying in grad school or not? But ethically, it could be a time of change. It's not going to all happen certainly within the next 5 years, but an example right now is looking at energy prices. When they were so high, we saw a lot of interest in how do we weatherize homes, how do we start to convert to bicycle traffic, you know, taking the bus, the whole transportation industry of bringing the trains here. I think Steve's right that we're going to have a lot impacting us locally and nationally depending on energy prices too.
Great. Keith?
Well, I think, you know, in the future 10 years, we're going to see more focus on savings, having resources to take care of those issues that come up for home ownership, the maintenance issues that come up, how do we not borrow additional debt to do those kinds of things. We're also going to see, I think, as far as housing finance we're going to see the ethical issue of grants versus loans. Should we be doing more grants, which provide people with equity? Is that really the government's role with affordable housing? Or should we look a lot more like a bank? Should we be a lender? And that's something that we currently struggle with, and I think it's going to be a continued struggle. And I think in the future we're going to see a much different economic model that looks at education as one of those key components. And it's not just going to be, as I mentioned before, K-12 education is going to be a key component. It's going to be that post-secondary. What is, as Tony mentioned, what is going to be that return on your investment? You're going to go into debt to go to school. You're going to the high school diploma when Tony graduated from college was the standard. Or no, was it that standard? Yeah, that was the standard back then. When I got out of college, it was the undergraduate degree is the standard. The master's degree is probably going to be the standard for most of you as you leave college, and soon it may become a higher degree than that. Is that going to be enough of a return on the investment that you're going to have to make to go to school, or do we have to look at more of a government partnership like an AmeriCorps program where you spend some time giving back to the community you're in or giving back to the government some time and service to pay off some of that debt?
Tony, you've got the final word.
I'll agree with everything that's been said first, before me. Just a bigger picture, I believe we're entering a generational pendulum swing towards a more liberal, egalitarian culture. 5 years from now, taxes will be higher on the rich. We'll be caring about our poor people again. We'll be addressing health care and things like that. I believe that will mean higher taxes on the upper middle class and the wealthy, but it'll be towards a better concept of less selfishness and more community, more what's best for the country.
Great.
There you go.
Let's have a round of applause for our panelists. Thanks to Tony Barrett, Keith Hamry, Pam Kramer, and Stephen Lewis. Special thanks to our funders and the sponsors of this series, the C. Charles Jackson Foundation and the Blandin Foundation, who fund us, Minnesota Power for their cooperation and support, and the Duluth Chamber of Commerce. I also want to thank Linnea Mersch, Kathy Modine, and Sharon Lohman for their behind-the-scenes work in planning and preparing this session for us today. And Alex, thank you for running the mic for us. Finally, thank you for attending. Don't forget to check out our CSR website for further information, for web links to video streams, and information about future programs. And don't forget the reception outside here in the foyer. You can talk to our speakers for a half an hour and have some refreshments. Thanks for being here. Good night.